All right, Andrew John here, and I need you to lock in for the next few minutes. What I'm about to share with you is not speculation, it's not theory, and it's not another sensationalized headline designed to generate clicks. Between February 3rd and February 7th, 2026, regional banks across the Midwest and Southeast processed withdrawal requests totaling $47 billion. That's not an annual figure, that's a 5-day window. And the number isn't coming from fringe financial blogs or conspiracy theorists. It's buried in the Federal Reserve's H.8 data release, the weekly report on assets and liabilities of commercial banks that most investors never read. Now, here's what this is not. This is not a panic-driven bank run where people are lined up outside branches demanding cash. This is not a social media-fueled crisis that disappears in 48 hours. And this is not a liquidity squeeze that resolves itself when the Fed opens the discount window for an afternoon. What this is a quiet, methodical reallocation of deposits by institutional clients, high net worth individuals, and corporate treasury departments who are reading the same balance sheet data I'm about to walk you through. And they are moving their money out of regional banks and into either money market funds, short-term treasuries, or in many cases, physical assets outside the banking system entirely. The reason the media is not covering this is because the mechanism is slow enough to avoid triggering FDIC intervention protocols, but fast enough that by the time the average depositor understands what's happening, the banks will have already been forced into emergency mergers, recapitalization events, or outright resolution. And if you think your deposits are safe because of FDIC insurance, I need you to understand something that will reshape how you think about your financial security. The FDIC insurance fund holds $128 billion. Total insured deposits in the United States banking system exceed $10 trillion. That's a coverage ratio of 1.28%. If even 2% of insured deposits were simultaneously claimed, the fund would be mathematically insolvent. Over the next 25 minutes, I'm going to walk you through exactly why this withdrawal wave is happening, what the balance sheet stress looks like inside these institutions, and most critically, the 3 moves you need to make this week to ensure that your wealth is not trapped inside a system that is designed to convert your deposits into equity during a resolution event. This is not a drill. This is a process that has already started, and the window for positioning is narrowing with every business day that passes. Before we dive into the current mechanics, you need to understand the framework that governs how modern bank runs unfold. Because the image most people have in their minds, the Great Depression era photographs of crowds outside bank doors, is completely obsolete. Modern bank runs happen electronically, and they happen in stages that most depositors never see until the final stage, when the bank is already in receivership. The framework is called the silent withdrawal cascade, and it operates through 3 distinct phases. Phase 1 is institutional repositioning. This is when large depositors, corporate treasury departments, pension funds, and family offices begin moving deposits in amounts that trigger currency transaction reports but don't yet breach the thresholds that force regulatory disclosure. These moves are quiet, they're spread across multiple transactions, and they're rationalized as routine cash management. The banks report them as normal fluctuations in deposit flows. Phase 2 is when the velocity accelerates. Once the first wave of institutional clients move out, the banks are forced to liquidate assets to meet withdrawal requests. And because many of those assets are held at a loss due to the interest rate environment we've been in since 2022, those liquidations crystallize losses on the balance sheet. When quarterly earnings are released and those losses show up, it triggers the next wave of withdrawals from depositors who read financial statements and understand what unrealized losses becoming realized losses actually means. Phase 3 is the public awareness stage. This is when the story breaks in regional media, when social media amplifies the concern, and when retail depositors begin moving their funds. By this point, the bank is already in discussions with regulators about emergency liquidity facilities, potential mergers, or orderly liquidation. And if you're a depositor at that stage, your options are limited. You are no longer proactively protecting your wealth. You are reactively hoping that the FDIC process works smoothly and that your funds above the insurance limit are eventually made whole through a claims process that can take months or years. The core thesis of this video is straightforward. We are currently in phase 2 of a withdrawal cascade affecting regional banks with concentrated exposure to commercial real estate, long-duration securities, and depositor bases that skew institutional rather than retail. The mechanics that are driving this are not emotional. They are mathematical. These banks are holding assets that have declined in market value by 15 to 30%, while their deposit liabilities remain at par. That gap represents a solvency problem that has been masked by regulatory accounting rules that allow banks to carry securities at amortized cost rather than mark to market. But when depositors withdraw and the bank is forced to sell those securities to raise cash, the fiction ends and the losses become real. The asymmetry here is that informed depositors are moving now, before the public phase, while uninformed depositors are waiting for confirmation that will only come after their optionality has been removed. This is the critical insight that separates wealth preservation from wealth destruction in a banking crisis. The sequence matters more than the magnitude. Moving early, even if it feels premature or unnecessary, is the only strategy that guarantees you maintain control of your capital. Now let's ground this in history because the pattern we're seeing today is not new. It has played out twice in the last century with precision, and the investors who recognized the early stages and acted decisively were the ones who preserved and multiplied their wealth. The first parallel is the banking panic of 1930 to 1933. Most people remember the stock market crash of 1929, but the real systemic destruction happened in the banking sector over the following 3 years. Between 1930 and 1933, more than 9,000 banks failed in the United States. These were not just small rural banks. These were institutions that held the deposits of businesses, farmers, and families who believed their money was safe. The failure mechanism was identical to what we're seeing today. Banks had lent aggressively during the 1920s expansion, particularly in real estate and agricultural loans. When asset values collapsed and borrowers defaulted, the banks were left holding collateral worth far less than the loan balances. As depositors began to worry about solvency, they withdrew funds. The banks were forced to liquidate assets at fire sale prices, which crystallized losses and triggered more withdrawals. The cascade accelerated until the banking system effectively froze. Now, here's the critical insight. The depositors who lost everything were the ones who waited. They believed that their bank was different, that their relationship with the institution mattered, or that the government would step in to protect them. By the time they tried to withdraw, the bank was already closed. The depositors who preserved their wealth were the ones who moved early, even if it felt uncomfortable or premature. They withdrew cash, they moved funds to larger institutions with stronger balance sheets, or in many cases they converted deposits into gold before Executive Order 6102 made private gold ownership illegal in 1933. The lesson from the 1930s is not that every bank will fail. The lesson is that in a cascading withdrawal environment, timing is the only variable that matters. Once the public phase begins, your options disappear. The banks that survived were not necessarily the ones with the best loan portfolios. They were the ones that retained depositor confidence the longest. And that confidence, once broken, cannot be restored through press releases or regulatory statements. The second historical parallel is the savings and loan crisis of the 1980s and early 1990s. This crisis is less discussed today, but it offers an even more precise template for what's unfolding now. During the 1970s, savings and loan institutions, which were specialized banks focused on mortgage lending, had issued long-term fixed-rate mortgages at interest rates between 5 and 7%. When Paul Volcker raised the federal funds rate to 20% in 1981 to break the back of inflation, the S&Ls were trapped. They were paying depositors 12 to 15% to keep their funds in the institution, but their mortgage portfolios were only earning 5 to 7%. The math was unsustainable. For every dollar they held in deposits, they were losing money. Over the course of the 1980s, more than 1,000 S&Ls failed. The Resolution Trust Corporation was created to liquidate the assets, and the final taxpayer cost exceeded $130 billion. But here's the part that matters for today. The institutions that failed first were not the ones with the worst loan portfolios. They were the ones that experienced the first wave of deposit withdrawals. Once depositors started moving funds, the S&Ls were forced to liquidate their mortgage portfolios at a loss, which made the balance sheet insolvency visible and triggered even faster withdrawals. The institutions that survived longer were the ones that had stickier deposit bases, depositors who didn't pay attention to the balance sheet stress until it was too late. The asymmetry was stark. Informed depositors moved their funds to money market funds or treasury securities and avoided losses entirely. Uninformed depositors watched their institutions fail and spent years in FDIC claims processes trying to recover funds above the insurance limit. The lesson from the S&L crisis is that balance sheet stress driven by interest rate mismatches is a solvency problem, not a liquidity problem. And solvency problems cannot be solved by central bank lending facilities. They can only be solved by recapitalization, merger, or liquidation. And in every one of those scenarios, depositors with balances above the insurance limit take losses. Now let's connect these historical patterns to what is happening right now in February 2026. According to the Federal Reserve's H.8 data, which tracks weekly changes in bank balance sheets, commercial banks reduced their total deposit liabilities by $47 billion in the week ending February 7th. That figure alone is not unprecedented. Deposits fluctuate week to week based on tax payments, corporate cash management, and seasonal patterns. But when you break down the composition of those withdrawals, the picture becomes alarming. The largest declines were concentrated in large time deposits, which are institutional deposits with balances over $250,000, and transaction accounts at domestically chartered commercial banks excluding the top 25 largest institutions. In plain language, this means that institutional depositors are pulling funds specifically from regional and community banks, and they're doing it in a way that suggests this is not routine cash management. This is risk reduction. Now, why is this happening? The answer is in the asset side of these banks' balance sheets. During the zero interest rate environment from 2008 to 2021, regional banks accumulated massive portfolios of long-duration securities, primarily mortgage-backed securities and treasury bonds, because those assets offered a yield premium over cash and were considered safe. But when the Federal Reserve raised interest rates from near zero to over 5% in 18 months, the market value of those securities collapsed. A 10-year Treasury bond issued at a 2% coupon in 2020 is now worth roughly 85 cents on the dollar because new bonds are yielding 4.5%. A 30-year mortgage-backed security issued at 3% is worth even less. The banks don't have to recognize those losses on their income statements as long as they hold the securities to maturity and classify them as held to maturity rather than available for sale. But the losses are real. And when depositors withdraw funds, the banks have two choices. They can borrow from the Federal Reserve's discount window or the Bank Term Funding Program, which allows them to pledge those underwater securities at par value for short-term loans, or they can sell the securities and take the loss immediately. In the first quarter of 2023, when Silicon Valley Bank and Signature Bank failed, we saw exactly what happens when large depositors lose confidence in a bank's ability to manage this interest rate risk. Silicon Valley Bank experienced $42 billion in deposit outflows in a single day, which forced the bank to sell its available-for-sale securities at a $1.8 billion loss. That loss was reported in an 8K filing. Within 48 hours, depositors withdrew another $100 billion through electronic transfers, and the bank was placed into FDIC receivership. The bank run happened in 72 hours, entirely electronically, and by the time retail depositors understood what was happening, the bank was already closed. What we're seeing now in February 2026 is the early stage version of that same dynamic, but it's distributed across multiple regional banks rather than concentrated in one or two institutions. The $47 billion withdrawal figure from the H.8 data represents roughly 1.2% of total deposits at regional banks outside the top 25. That number might sound small, but the velocity is what matters. If that rate continues for 4 weeks, you're looking at a 5% decline in deposits. And at that threshold, banks are forced to start liquidating securities portfolios to meet withdrawal requests. When those liquidations begin showing up in quarterly earnings reports as realized losses, the next wave of withdrawals will accelerate. The cascade is already in motion. The only question is how fast it moves and which institutions are forced into resolution first. The mathematical inevitability is what makes this different from normal market volatility. This is not a sentiment problem that can be fixed with better communication. This is a structural imbalance where the assets and liabilities are mismatched in a way that cannot be resolved without either massive capital injection or forced liquidation. Now let's talk about the quiet mechanism that makes this different from previous bank runs, and this is where most depositors are dangerously misinformed. The legal framework that governs bank failures changed fundamentally after the 2008 financial crisis. Title II of the Dodd-Frank Act, which was signed into law in 2010, gave the FDIC explicit authority to place systemically important financial institutions into a resolution process called orderly liquidation authority. And embedded in that authority is the bail-in mechanism. Here's how it works. When a bank is placed into receivership, the FDIC takes control of the institution. Shareholders are wiped out immediately. That's standard. Bondholders, meaning people who lent money to the bank by buying its corporate bonds, take a haircut. Their bonds are either converted to equity at a steep discount or written down. And then, if additional capital is needed to stabilize the institution, the FDIC has the authority to convert uninsured deposits, meaning any deposit above the $250,000 FDIC insurance limit, into equity in a bridge bank or a restructured entity. This is not theoretical. This exact process was used in Cyprus in 2013 when the Bank of Cyprus and Laiki Bank were restructured. Depositors with balances over 100,000 euros had up to 47.5% of their deposits converted into equity in the restructured bank. That equity was worth a fraction of the original deposit value, and many depositors never recovered the full amount. The same framework has been adopted across the European Union under the Bank Recovery and Resolution Directive, in the United Kingdom under the Banking Act of 2009, and in the United States under Dodd-Frank. The reason this matters right now is that the majority of large depositors in regional banks, corporate treasury accounts, law firm trust accounts, medical practice operating accounts, have balances that far exceed the $250,000 insurance limit. A law firm with 50 employees might keep $5 million in operating cash in a regional bank checking account. Under the current framework, $250,000 of that is insured. The remaining $4.75 million is an unsecured liability of the bank, and if the bank is placed into resolution, that $4.75 million can be converted into equity that may ultimately be worth 20 cents on the dollar or less. This is not a risk that most business owners or corporate treasury managers fully understand, and it's exactly why institutional depositors are moving funds now before the resolution process begins. Let me give you a specific example to make this concrete. In 2023, when First Republic Bank was seized by the FDIC and sold to J.P. Morgan Chase, the bank had approximately $104 billion in deposits. Of that total, roughly $90 billion was uninsured, meaning it exceeded the FDIC limit. Those depositors were made whole only because J.P. Morgan agreed to assume all deposits as part of the acquisition. But that outcome was not guaranteed. If J.P. Morgan had declined to purchase the bank, or if they had negotiated a deal that excluded uninsured deposits, those depositors would have become unsecured creditors in a receivership process. They would have filed claims, waited months or years, and potentially recovered 60 to 80 cents on the dollar if they were lucky. The reason First Republic depositors were protected is because the failure was contained to a single institution and a systemically important acquirer stepped in. But if multiple regional banks enter resolution simultaneously, there will not be enough healthy acquirers to assume all the uninsured deposits. At that point, the bail-in framework becomes the primary resolution mechanism, and uninsured depositors take losses. This is the scenario that institutional clients are pricing in when they move funds out of regional banks. They are not waiting to see if their specific bank will be one of the lucky ones that gets acquired. They are eliminating the risk entirely by moving to institutions that are too big to fail or into treasury securities that have zero credit risk. So what are the three asymmetric moves you need to make right now to ensure that your deposits are not trapped in this cascade? The first move is immediate deposit reallocation. If you have any accounts with balances above the FDIC insurance limit of $250,000, you need to move those funds this week, not next month, this week. The mechanics are simple. You can split deposits across multiple banks to stay under the limit at each institution. You can move funds into a money market fund that invests in treasury securities which have zero credit risk, or you can move into short-term treasury bills directly, which you can purchase through Treasury Direct or a brokerage account. The key is to eliminate your exposure to uninsured deposits at regional and community banks. The asymmetry here is that moving now costs you nothing. The interest rate differential between a bank savings account and a treasury money market fund is negligible, often just 10 to 20 basis points. But the downside risk of staying in an uninsured deposit account at a vulnerable institution is a potential 50 to 100% loss of the uninsured portion if the bank enters resolution. That's not a trade. That's a risk management decision that every rational actor should make immediately. If you run a business, you need to sit down with your CFO or accountant this week and map out every account where your operating cash sits. If any single account exceeds the insurance limit, you need to restructure immediately. The cost of inaction is catastrophic. The cost of action is zero. The second move is to establish a position in physical precious metals as a systemic hedge. Gold and silver are the only assets that have zero counterparty risk, that exist outside the banking system entirely, and that have maintained purchasing power across every banking crisis in modern history. Right now, gold is trading near $2,700 per ounce, and silver is around $31 per ounce. Both metals are at elevated levels compared to their historical averages, but in real terms adjusted for inflation, gold is still 30% below its 1980 peak, and silver is 60% below its 1980 peak. The reason precious metals matter in a bank-run environment is because they are the ultimate form of liquidity that cannot be frozen, seized, or converted. If you hold physical gold and silver in your possession, or in a fully allocated segregated vault, no bank, no regulator, and no government entity can unilaterally convert that into equity in a failing institution. It is final settlement. And in an environment where deposit safety is conditional, that matters more than most investors realize. The allocation should be meaningful. I'm talking about 10 to 20% of your liquid net worth as a minimum. And if you understand the systemic risk we're discussing, 30% is not unreasonable. You want to buy physical bars and coins from reputable dealers. You want to avoid numismatic premiums and collectible markups. And you want to store it either in a safe at home or in an allocated vault with a company like Brinks or Loomis, where you have a specific serial numbered bar assigned to your account. The asymmetry is that in a systemic crisis where bank deposits are being bailed in and currencies are being debased through central bank interventions, gold and silver will appreciate in nominal terms to offset the loss of purchasing power in fiat currency. You're not speculating on a price move. You're insuring against a scenario where the banking system's credibility collapses. During the banking panic of the 1930s, gold was revalued from $20.67 per ounce to $35 per ounce, a 69% gain, while the banking system was frozen and depositors lost access to their funds. During the stagflation of the 1970s, gold went from $35 to over $800, a 2,200% return as confidence in the dollar collapsed. The pattern repeats because gold is the only asset that cannot be printed, that has no counterparty, and that every central bank on the planet holds as a reserve asset. If central banks trust gold as the ultimate backstop, you should too. The third move is to build exposure to senior secured credit in distressed situations. This is a more sophisticated play, but the asymmetry is enormous. As regional banks are forced to liquidate loan portfolios to raise cash, there will be a wave of distressed commercial real estate loans, middle market corporate loans, and asset-backed securities hitting the secondary market at steep discounts. Senior secured debt means you have first lien on collateral, so even in a bankruptcy scenario, you're at the front of the line to recover value. The opportunity is to buy these loans at 60 to 70 cents on the dollar when a bank is in distress and needs to clear its books, and then either hold them to maturity and collect par, or restructure them and take control of the underlying asset. For retail investors, the cleanest way to access this is through closed-end funds and business development companies that specialize in distressed credit. These vehicles trade at discounts to net asset value before a distress cycle, and then as they deploy capital into high-yield opportunities, the discount closes and you capture both the income from the loans and the capital appreciation from the discount narrowing. The names to look at are funds managed by Oaktree Capital, Apollo Global Management, and Ares Management. These are firms that made billions in the 2008 crisis by buying distressed assets when banks were forced sellers. The setup today is similar. Banks are holding assets they need to sell. Distressed credit funds are sitting on record levels of dry powder, and the spread between where banks need to sell and where buyers are willing to pay is creating opportunities that won't last once the distress becomes headline news. The key is to position now before the public phase of the cascade, because once the media covers the story and retail investors flood into these funds, the discounts will have already closed. Now let's talk about the signals that tell us this withdrawal cascade is accelerating, because the data is not ambiguous. In addition to the $47 billion decline in deposits reported in the H.8 data, there are three other indicators that are flashing red. First, the Federal Reserve's Bank Term Funding Program, which was created in March 2023 to provide emergency liquidity to banks after the Silicon Valley Bank failure, saw utilization increase by $12 billion in the first week of February 2026. That program allows banks to borrow against their underwater securities portfolios at par value, which means banks are using this facility because they are experiencing deposit outflows and they don't want to sell their securities at a loss. The fact that utilization is increasing means the deposit stress is getting worse, not better. This is the equivalent of a business tapping its credit line not because of growth opportunities, but because it's struggling to meet payroll. It's a desperation move disguised as routine treasury management. Second, the spread between the effective federal funds rate and the interest rate that banks are offering on savings accounts has widened to 180 basis points. In a normal environment, that spread is 50 to 100 basis points. A 180 basis point spread means banks are desperate to retain deposits and they're willing to pay above market rates to prevent further outflows. This is not a sign of strength. This is a sign of stress. When a bank starts offering dramatically higher rates than competitors, it's because depositors are leaving and management is trying to stop the bleeding. The problem is that paying higher rates on deposits while holding assets that yield far less accelerates the insolvency. It's a short-term fix that makes the long-term problem worse. Third, commercial real estate loan delinquencies at regional banks have increased to 7.2%, which is the highest level since 2012. That number matters because commercial real estate loans represent 30 to 40% of the loan portfolios at many regional banks. If those loans start defaulting in size, the loan loss provisions will eat through capital, and depositors will see the solvency risk crystallize on quarterly earnings reports. These three data points, increasing utilization of emergency liquidity facilities, rising deposit rates to retain funds, and climbing loan delinquencies, are the same early warning indicators that preceded the bank failures in 2008 and the S&L crisis in the 1980s. The pattern is repeating with precision. Before we wrap up, I want to address the question that's probably running through your mind. If this is such a clear risk, why isn't the mainstream financial media covering it? The answer is twofold. First, the withdrawal process is slow enough that it doesn't meet the editorial threshold for breaking news. A $47 billion decline in deposits over a week sounds significant to someone who understands bank balance sheets, but it's not a headline that generates clicks or television ratings. The media covers bank runs when there are lines outside branches and panicked customers. They don't cover the institutional withdrawal phase that happens electronically and quietly. Second, there is a vested interest in maintaining confidence in the banking system. Regulators, bank executives, and policymakers understand that public awareness of deposit stress can accelerate the very cascade they're trying to prevent. So the communication strategy is to minimize, to frame any data as temporary fluctuations, and to emphasize the strength of FDIC insurance. The problem with that strategy is that it leaves retail depositors and small business owners unaware of risks that institutional clients are already acting on. By the time the story becomes mainstream news, the opportunity to protect yourself proactively has already closed. This is exactly what happened with Silicon Valley Bank. The institutional depositors, the venture capital firms, and tech companies started moving funds on Thursday, March 9, 2023. By Friday morning, the bank was experiencing a full-scale run. By Friday afternoon, it was in receivership. Retail depositors and small business owners found out from news headlines that their bank had failed. They never had a chance to withdraw because they didn't have access to the same balance sheet analysis and risk intelligence that the institutional clients had. That information asymmetry is the reason why some depositors lose everything while others move their funds days before the failure. The asymmetry is not about luck. It's about access to information and the willingness to act on that information even when it feels uncomfortable. So here's the question I want you to answer in the comments, and I want real feedback, because this community is built on shared intelligence. Do you currently have deposits above the FDIC insurance limit in a regional or community bank? And if so, are you planning to reallocate those funds, or are you waiting to see how this develops? I want to know where you stand, because the decisions you make over the next 2 weeks will determine whether you're positioned ahead of this cascade or caught in it. And if you found value in this breakdown, if you understand why the withdrawal data matters and why the media silence is actually more concerning than reassuring, then I need you to do 2 things right now. First, hit that subscribe button and turn on notifications, because I'm tracking this data weekly and I will update you as the situation develops. This is not entertainment content. This is real-time risk analysis that could determine whether you preserve your wealth or watch it get trapped in a resolution process. Second, share this video with anyone you know who has significant deposits in regional banks, who runs a business with operating cash accounts, or who manages corporate treasury functions. They need to see this information because their bank is not going to call them and suggest they move their funds. By the time the bank is in distress, it will be too late to act. The withdrawal cascade is happening now. The mechanics are mathematical, not emotional, and the asymmetry is stark. Informed depositors are moving. Uninformed depositors are waiting. The only question is which side of that divide you're going to be on. I'll see you in the next one.